On this show, we want to recap the week, and what we're going to do is do our Wrap the Week segment every Friday. We love to take a step back. Now that Friday's closed is locked in, we've got the weekly bar in place. What does this mean? And I would say by any measure, this week has been crazy. Crazy is the adjective that I'll use to describe it. And it's funny, I was joking with Jay Woods. We'll hear his discussion earlier. We caught up with him via phone earlier today. And he made the comment. We saw him on the floor of the exchange in December. It was right before the Christmas holiday, the holiday season, and we made the comment about how we were looking for volatility. Volatility was so low; it was like things were just kind of boring. And boy, I feel like our cup runneth over with the volatility we were expecting or hoping for back there in December. This is what the week looks like. Looking at the last 5 trading days, you can see Monday was actually a rare up move. Mondays have actually been kind of weak going back over the last 6 weeks or so. It's actually rare to see a nice uptick on a Monday. Tuesday, we sort of gave it back. Wednesdays where we really started to feel the pain. And again, then Thursday back up, Friday back down, and sort of this, swinging pattern back and forth. So directionally, down a bit on the week. But overall, I feel like this week was more marked by the volatility and the indecision. So you have up days, you have down days. There's no real clear differentiation between the two. When you look at the daily chart of the S&P, that's sort of what this feels like. After that big, sell-off into last Monday, right, a week ago or a week or two ago, you had this big jump higher on the S&P. You had the rally back to just below 2650, and now we're sort of in the middle of that range. And the question now, I think, on everyone's mind is just where we're at relative to these extremes. We've now sort of hit an equilibrium of sorts around the 2,500 level. And now the question is, what's next? All right, what's that next move? We're going to come back to that, try to make sense of it. But just very quickly, what you have to look at today is the S&P finishing down 1.5%. Small caps and mid caps down even more. I think that's very telling. Small caps down 3.5%, so much deeper. In terms of sectors, it was really more defensive led when you had staples and then real estate at the top. Consumer staples, the only sector out of the 11 on the positive today, with utilities, materials, financials on the way down. Going back to the daily chart here, one of the questions that I would think about is where we're going next. We have a poll that we asked not too long ago about where people were potentially expecting the market to go next. Was it going to go above 2,800, below 2,300, or end up in the middle over the next couple months, right, ending at the end of the second quarter? The average answer was right in the middle. We had a very small percentage saying above 2,800. We'll call you our raging optimist. I think it was about 10% of respondents. So that's impressive optimism there based on all the headlines we're seeing. But listen, you could absolutely be right. But then most people said we would either be within this range or lower. So I think it's telling that about 90% of our respondents say we would be below 2,800 3 months from now, which I think is completely reasonable. And again, a lot can happen in 3 months, but I don't think that's necessarily far off. In the short term, and I think this is, in our mailbag segment, we're going to answer some questions about this, but I would say in terms of short-term levels as we finish the week, we always start with the final bar, start with the current price bar, and then look back to the left. Where are we at relative to key support and resistance levels? The last couple days has given us a key support level right around 2,450 on the S&P. So as long as we hold that, I think we're relatively stable. We're in good shape. We break below 2,450. I immediately am looking down to 2,200, to be honest with you. I think that's the next key level that you could expect support. However, if we rally and break above 2,650, that's the key resistance from earlier on in the week, also from last week. And that also lines up with the Fibonacci resistance level. So we're kind of very fortunate right now to have some clear levels in place. We break above 2,650, we break below 2,450. I would argue whichever way we go, that's the short-term direction of momentum that you certainly want to try and follow. To wrap the week, we usually like to look at the Mindful Investor Live chart list. If you've not looked at this before, just go to the articles tab, go to my section, Mindful Investor, and you can download this directly to your StockCharts log and use them at your leisure. But we'll start at the top here. So this long-term trend following model just turned negative last week. This is our long-term model based on the 21 and 34 week exponential moving averages. So it remained positive, coming down, very quickly, but still remaining positive until last week when it finally triggered negative. Our shorter-term tactical model turned negative mid-February and remains in a position of severe weakness, really lining up with historical bear market phases. We're talking back to the 2008 period, to be honest with you. Last time it's looked this severe to the downside. So overall, suggesting it's more weaker than stronger. You want to be thinking more potential downside here. You know, the cumulative advanced decline lines are interesting. We haven't locked in today's close yet. And so I think the question for me, along with the broader market, is higher highs and higher lows, or lower lows and lower highs. We're coming off of a lower low. That's this bottom here from the third week in March across the board on all of these breadth measures. We've now bounced up a little bit, establishing a lower high. And now the question is, do we find a higher low? Do we remain above a week ago reading, or do we break to new lows? We continue this pattern. And I think we'll see how today locks in as we digest all the breadth readings from today, and also see how we go into next week. You know, as a final reminder here, I just want to point out with breadth, I'm always looking at the stocks above their 50 and 200-day moving averages. I think it's really telling that the stocks above their 200-day, stocks above their 50-day have really eclipsed the short-term bull market bottoms that we saw back here in the last 10 years. We're looking a lot more closely related to that late 2008 period, which means we're at the beginning of a process. That reading where we're at now, if you use that parallel, the bottom didn't come for another 5 to 6 months after that first initial bombed out reading. So the breadth picture, in my opinion, remains relatively muted. You know, to give enough time for a conversation with Jay Woods, which I do want to make sure we get to, we're going to cut that short for the wrap of the week. If you have time to go through that Mindful Investor Live chart list, you're going to see a lot of ratios that help paint the picture. But again, overall, I think we finished this week, in my opinion, confirming more a bearish bias than a bullish bias.